Yeah, well, good morning. Good to see such a lovely crowd today. Really impressive event. Congratulations to all the organizers of this event, including the Right Honorable Dr. Liam Fox, who's become a fast friend since our time together in Glasgow at COP26. My name is Drew Bond. I'm the president and CEO and co-founder of C3 Solutions. C3 Solutions is the conservative coalition for climate solutions. I know that that might often surprise people that there are conservatives that believe in the issue of climate in terms of how important it is to really focus on solutions, but we do. We were founded in 2020 with the real mission of promoting free market principles and policies around all things climate, energy, and the environment. I'm also an investor in my own company and an entrepreneur and founder of a solar racking company called Powerfield Energy. So I bring to this discussion some of my own experiences, but we're really here to meet with these particular investors. So you've got a real treat. Not only are they experts in their field, they are incredible human beings and really committed to making this world a better place and finding ways to accelerate innovation through their own skills, through their own relationships, and certainly through the capital that stands behind them. So let me, with that, I'll just quickly introduce, and then I'll ask them to say a few things about their backgrounds, who they are, how they got to where they are today. But so first on the far left there is Amy Dufour. She is a general partner at Azola Ventures. And think of Amy as the early stage part of the capital stack. Next to hers, right, her left, I guess, is Michael Bruce. Michael Bruce is a partner venture investing at Emerson Collective. Full transparency, Michael and I are longtime friends and worked together at the Department of Energy under George W. Bush. So glad that he can be here together. We can be together in London. So he's kind of the middle stage capital stack. And then to his left is Kojo Ako-Asar, Managing Director of Decarbonization Partners, which is a BlackRock and Temasek joint venture. So Kojo is the latter stages of the capital stack. So with that, I'm going to walk over to the stage and we'll get right into it. So Amy, can we start with you since you are the earliest stage of capital? Tell us about you, how you got into this business, and tell us about your fund, because as I think about those investors, those entrepreneurs out there, I think people are particularly inspired by people's stories. We talked about this earlier. So tell us your story a little bit, how you got here.
Well, first of all,
Is your mic on? Yeah?
I'm not sure.
I don't know. We might have to.
So,
There we
okay,
go.
there
Great.
we go. First of all, it's great to be here with everyone. My story is an interesting one. It is anything but linear. And as Drew mentioned, I'm a co-founder and general partner at Azola Ventures. I grew up in the Philadelphia area, and after undergrad in New York, I actually made my way to the UK. So I'm very fond of this country, and I'm so grateful to be back here. I went to grad school at Oxford, and then afterwards started out my career in London, where I was an operations-focused management consultant, really focusing on supply chain and procurement, so the building blocks of businesses. And after a couple of years, I ended up moving to Singapore, where I worked for Barclays, and became really excited about the prospect of supporting companies that had environmental impact. And so after some time there, I transitioned to an impact investing firm called IIX, where I ran these early stage venture accelerator programs around Southeast Asia. And one of the interesting things about Asia is it's one of the places most at threat from climate change. I mean, we're all going to be impacted, but a number of different conditions makes Southeast Asia particularly vulnerable. Spent some time there and then ended up making my way back to the United States, where I became a renewables investment banker at Bank of America and then joined our firm at Azola Ventures. So you'll look around and think US, UK, Singapore, back to the US, lots of different industries, but there is a common theme there, which is that I felt that climate change was the most important fight of our generation and really wanted to focus my efforts on the early stage climate investing side. So when I talk a little bit about Azola Ventures and what we do is Azola Ventures is a 280 million AUM early stage climate tech fund. We're based in Boston. And we have a unique structure. We're really purpose built to support climate tech companies and primarily hardware based companies at the earliest stages. And so our unique fund structure combines what we call catalytic capital, which is structurally more patient and flexible capital, really designed to de-risk early stage climate technologies alongside more conventional venture capital. We think this allows us to invest in companies that are more right-sized to their risk and reward profile, and our entire fund invests in these early stage, so for us that means pre-seed, seed, and Series A rounds, hard tech companies that each have the potential for gigaton scale greenhouse gas emissions reductions. So I'll stop there.
So maybe just one quick question. So what size checks do you write for the folks that are interested in approaching your firm?
Good question. $2 million is our average initial investment check.
All right, thank you. Michael, tell us a little bit about yourself and Emerson.
Yeah, thank you guys for having me. It's wonderful to be over here. And as a California-based investor, we often look at what's going on over in Europe, particularly over the last 12 months, and realize that necessity is the mother of invention. And while a lot of us have been working on energy technologies for a decade or two, there's an opportunity to deploy them over here right now for market conditions that wanted to come and get close to it and get a chance to meet more of you. As Drew mentioned, I have the privilege of not only having one former colleague, but two former colleagues on the stage with me. Drew and I worked together at the Department of Energy 15 years ago.
Long time.
And Kojo and I worked together at Emerson. So he can actually give the same speech that I'm about to give about what Emerson's up to. But so Emerson Collective, we're a venture capital firm, as well as a philanthropic firm and a policy advocacy organization. We're the family office of Lorraine Powell Jobs. My job is to invest in the most consequential companies working on solving climate of this generation. Typically, I invest at Series B, so Amy kind of gets things going and then hands the ball to me, and if I do my job right, I'll have a ball to hand to Kojo a few years later. We invest up and down the EV supply chain as well as in technologies for the energy system. In general, we're looking for technologies that can have large transformative impact. Typically, that's either going to be a material science breakthrough, where there's a demonstrable advantage from first principles of what the technology can do for the energy system, or it's going to be a software platform that can really accelerate those material science innovations that are already in the money. My organization also invests in a variety of other sectors, including oncology, media technology, education technology, financial technology. So it gives me an interesting view across what other sectors are doing. In terms of my story, I grew up in a family that's been doing energy for about 120 years. So I learned a lot about how oil is brought out of the ground around the dinner table. Even had a great uncle who built a nuclear power plant, which made for some really interesting conversations growing up. So I went to Stanford and fell in love with the intersection not only of energy, but also energy and technology, and then had a chance to join the Bush administration during the last energy crisis, where energy went from a sleepy backwaters issue to the thing everybody in Washington wanted to talk about. So it was a great opportunity to learn very fast, represent my country, and hopefully put some good new programs in place, including ARPA-E, an entrepreneur in residence program at the National Labs, the loan guarantee program at the Department of Energy. After that, I joined Hannon Armstrong, where I did sustainable infrastructure financing, and then joined Emerson about 5 years after that. So.
All right, and same question I gave to Amy. What size check do you write?
Typically, our first check is either $5 or $10 million, and one of our superpowers is our ability to be a full stack investor. So we can continue to follow on invest all the way up through IPOs thereafter.
All right, thank you. Kojo.
My turn?
Yes, sir.
All right. So similar to Amy, I have a nonlinear path to investing in climate. My career actually started after completing an engineering degree in aerospace engineering. I went and actually served the U.S. government as a Marine officer in Asia. After that, did some grad school, and then I started my professional career in finance as an investment banker, and did that for a number of years until I got a call to join a small tech company in Mountain View that some of you may have heard called Google. And so my role at Google was actually to be on the other side of the table, where as an investment banker, I was working against corporations. At Google, I was in the corporation working against bankers. And Google being a really novel place, really focused on innovation at the time, this was 2011, they very much wanted to green their operations. But when they went out to market to source the power, they realized that there was insufficient supply. And so Google was like, well, you're a finance person. At the time, they had $60 billion of cash in the balance sheet. I think now they're north of 200. Can we use our cash to solve our problem? Go figure it out, finance guy. And so from that point forward, we set up a process to invest in companies that were building out utility scale solar, utility scale wind, and some residential solar stuff. Did that for a number of years. It was very exciting. We put together and deployed about 700 megawatts of power, over $1 billion committed from Google's treasury. And then I got a call to join another part of Google called Google X, which is the moonshot factory. That's where you get the self-driving cars. That's where you get, you may not remember because at this point it's 10 years old, but the Google glasses. That's all comes out of Google X. So they had a renewable energy project there where they were trying to do a wind turbine without the tower. Airborne wind is what we called it. And so I was sent over there to help the team there. Did everything except engineering. Super exciting. From there, I ended up at another startup, which is a last mile EV company. Did that for a while. And then that's when my story intersects with Michael. In 2017, I joined Emerson Collective, where we co-led the investment practice for a number of years. We did a lot of really exciting things through that period. But a lot of you may remember about 2 to 3 years ago, there was this boom of enthusiasm around climate kind of generated through the SPAC market. And that then catalyzed a bunch of investors to start thinking maybe we should take a closer look, which then led to this rapid growth in capital formation around the growth category. And so a year ago, Decarbonization Partners came together, and through that process, they approached me and joining them and helping them grow their business. And so I joined Decarbonization Partners and left my longtime friend in the fall, and I've been with the organization for 6 months. Decarbonization Partners is a billion-dollar fund that is formed through the joint venture of 2 prominent organizations. Temasek, which is a leading investor in Asia and has been for a number of decades, and BlackRock, which is the largest asset manager on the planet. BlackRock manages $8 trillion of assets. And the idea was if we can bring capital from these 2 organizations to anchor our family of funds at decarbonization, can we then propel and advance and accelerate the deployment of climate technologies? Where we look to invest, based on the way you've sorted us, is we come in after companies have passed the R&D phase, and they're looking to just grow, hence growth capital. We scale up risk is what we call it, or engineering risk. The way I use a shorthand from my time at Google is when the dog eats the dog food, then we know it's time for us to invest. From venture capital letters A, B, C, D, we tell everyone we invest in B+, which is effectively the step after where my colleague here, Michael, invests. And we look to deploy between $25 and $75 million in our checks. But because our objective is actually to accelerate the capital flows into new companies and also demonstrate to people that this is a great place to deploy capital, we also look to lead investments so that we set the terms and we hopefully make it favorable for other investors to join us on our journey.
All right, thank you. So curious to know, we were talking a little bit backstage about headwinds, tailwinds. It felt like there were more tailwinds in Washington, certainly last year, around the money going behind the policy, which also led to tailwinds in the market. But then a few things happened along the way that have created some disruptions in the market. So I'm curious, and maybe we'll go from you back down to Amy, if that's okay.
Sure.
What do you see in terms of tailwinds, headwinds? How's your view of the market? Where do you see the most tailwinds? Where do you see the most headwinds?
Yeah, so in the growth space, right, we're dealing with technologies that are proven and with generally markets that want the next thing, right? Be it fusion, be it that whiz-bang electric vehicle. And so we're actually seeing a lot of pull in those very specific markets where not only it's the intersection of policy and also technology where people really, really believe that the future is here. And so specifically with kind of the rapid enthusiasm both of electric vehicles and also the increasing focus on energy security, we're seeing a lot of investments in and around the lithium-ion battery ecosystem. That's everything from cell production to all the upstream components, be it anodes, cathodes, and whatnot, and ultimately even recycling. And why do we see that is largely because we believe, unlike fossil fuels, it's very easy to recycle a used or a spent battery and turn that into a new battery. And so the entire ecosystem is seeing massive tailwinds. In addition to that, we're also seeing with the rapid decline of solar and wind, it's becoming really cheap to generate power. And so now we're starting to see business models that are looking to leverage the low cost of solar and wind, be it monetizing the low cost of storage and attaching storage to increase the use and utility of wind and solar. Or we're seeing what's emerging now is what's called a virtual power plant, where we take all these disparate storage units across a grid and then synchronize them so they actually appear no different than a gas turbine or a coal power plant. So there's a lot of enthusiasm there, and I would say right now there is a lot of momentum in the market. Now, if I was to compare that to what we saw just 2 years ago, I think there's definitely a bit of a correction in pricing, but unlike our peers that invest in SaaS businesses, is not as much a downward spiral. In fact, many would argue that it's predominantly flat in the growth space.
Yeah. And Michael, same question to you, but just also curious in your background and our time together, right? 2007, 2008, right? It was a really hot market for renewable energy. You spent a lot of time in Silicon Valley. At the time there was a lot of excitement around investing in all things renewable energy, and then that changed pretty quickly overnight. And then it felt like the venture capital world kind of pulled out of anything hardware and only went into all things software. Has that changed at all? Is maybe a caveat to that question.
Yeah, it's definitely changed. I'll kind of start with some of the tailwinds, because those are more fun to talk about, and then I'll go to the headwinds. So in terms of tailwinds, one of the biggest things that has changed, to Kojo's point, is just the cost entitlement of these new technologies is wildly different than it was a decade ago. Solar prices now, for the most part, it's the lowest cost energy you'll get on the grid.
Yep.
To where we actually need to start changing the words that we use to describe it. It's really bulk energy now, and we need to figure out how to store it. We need to figure out how to move it in the same way that we do with other bulk materials or products. You've also had the corporates actually coming to the table and buying. 10 years ago, that just wasn't the case. Most corporates didn't have someone like Kojo focused on how do we buy more renewable energy. But because it's gotten cheaper and because climate has become something that their investors care about, their stakeholders care about, their employees care about, their customers care about, corporates are really showing up and being purchasers, which is driving kind of the thing we care most about, revenue into these businesses. There's also been a development where there's a healthier supply chain of capital, a little bit represented on the stage here, where there is someone to hand the baton to next if you've developed a hard tech innovation. Maybe now I'll flip over to the headwinds that we're encountering, though. I've long said the largest incentive in the United States for climate tech, renewables, has been from the Fed. And the Fed has gone into reverse here recently and raising interest rates, given that renewables for the most part are all capital up front. That cost of capital really matters for the delivered cost of energy. So a lot of companies are struggling right now to learn the lessons of what happens when the interest rate environment moves in the opposite direction that it's moved for the last 10 years. Also, we're starting to run into bottlenecks that were predictable, but it's hard sometimes for regulators to make the changes until something breaks. One thing that's starting to break in the United States is our transmission system. Lawrence Berkeley National Laboratory had a report out a couple weeks ago. It said in the United States we have a 2 terawatt interconnection queue. And we only have 1.2 terawatts of electricity generating capacity in the United States already built over the last century. So we have a lot of renewable power wanting to find its way onto our transmission system, but we simply don't have the regulatory apparatus to figure out how to get that energy on the grid and ultimately to the market. One other significant headwind is, and Kojo alluded to it a bit, is the market right now is going through a pretty severe repricing. While revenue is growing and while technical milestones are getting knocked down on a regular basis, multiples have simply come in a long way since a lot of companies last would have raised capital. So traditionally a down round in venture is a bad thing. You don't want to have raised money at a certain price and have to come back to the market and raise it at a lower price, because it usually means your business model's not working, you had a warranty recall, you had something bad that has happened between those rounds. That's not the case right now. Down rounds are very common, and it's difficult on the entrepreneurs and the founding teams because often they figure their price is only going to go up as they de-risk their businesses. But we'll get through this. The market does this on a regular basis. It's a little bit like a forest fire. It's actually healthy for making sure businesses are efficient and growing. But it's definitely a headwind that the market's facing right now.
Yeah, good. Amy, for your perspective, how do things look?
Yeah, so I think I agree with everything that Michael and Kojo have said about where the market has really made corrections in terms of valuations. Given that my fund and my work really focuses on emerging technologies, I want to talk a little bit about the headwinds and tailwinds I'm seeing in that space. And I should have also mentioned up front that we really focus on overlooked and neglected areas in the climate space, despite the fact over the last 2 or so years, there's been a much renewed interest in climate. I mean, no pun intended, like climate's hot. Or actually, I should say pun intended, climate is hot. We've seen a lot of shift amongst traditional or more traditional venture investors across different climate verticals. So when I think about tailwinds, a couple of years ago, not a ton of climate VCs or cleantech VCs were investing in nuclear fusion. Nuclear fusion has been having a moment. There's been a ton of venture investment that has poured over the past year or so. Some, mega rounds like Commonwealth Fusion Systems out of Boston and others really across the fusion space. There's also been a lot of interest in heat pumps. I think you all can, identify with that, especially in Europe. I think we've really been, pushing the charge on that end. And then, as well, although that's not where we focus at Azola Ventures, we've seen a lot of interest in more capital efficient software-based solutions. So think carbon marketplaces, given the explosion of the voluntary carbon markets. Now, on the headwinds side, we think about climate across all verticals, and so while energy and transportation are a really important area, so is agriculture. Agriculture is responsible for over a quarter of global greenhouse gas emissions, and it often isn't brought as part of the story. Ag tech, frankly, has been having a really tough time over the past year or so, specifically alternative proteins, which I find interesting because in 2018, when we founded our predecessor fund, alternative proteins were kind of seen as like the safe bet for venture investors who wanted to get into climate. And when you think about Impossible Foods or Beyond Meat, the declining stock prices in the US, people have started to get a little bit nervous. They're like, man, maybe, that Impossible, burger that you're eating isn't as much of a safe bet as it was a couple of years ago. And so we're finding, because our fund really likes to focus on those neglected areas, that maybe in 2018 we wouldn't have been as interested in alternative proteins. We think that's really critical for deep decarbonization, and that's an area that we want to play in. One other vertical as well, which I think is starting to get kind of renewed interest amongst emerging technologies, is really technologies that are focusing on low carbon commodities. So think low carbon chemicals, plastics, sustainable textiles. A lot of VCs in the past didn't really want to invest in these types of companies because they're super capital intensive. I mean, outside of the fact that you have to build these really costly plants, there are really low margins that are associated. So a lot of VCs would say, hey, we're not sure about what our returns would look like. There's also a really high production and scale required to hit the volumes that are necessary, to sell into a commodity chemical market. And then outside of that, there's also a financing risk. So it's fascinating because even though we each represent different stages, or actually I should say Emerson represents all stages of the, the climate capital stack, there are quite acute risks at different stages of a company's life cycle. So we've seen in the early stage venture space, there's still a lot of activity. Valuations are still pretty steady, although they have been coming a bit down from the ridiculousness that's been around for the past 2 years. But, financing that first plant or project, so maybe you'll get early stage venture money from me, although I feel like, again, Emerson plays across, all elements of the capital stack. It can be really hard to get financing for that first of a kind plant or project because it's still deemed very risky for more traditional financiers. And so again, that's an area that other VCs in the past have tended to be a little bit nervous about, but knowing that plastics or other chemicals are a really huge decarbonization opportunity, I do think that's an area that people are starting to warm up to in the broader venture space.
Yeah, so I think all of you have probably broadly answered this question, but maybe let me ask you to put a little bit more of a point on it. And I'm going to mix metaphors. I'm going to throw a jump ball, and ask you where the puck is going. Okay. And I know people like to talk about the puck in terms of Wayne Gretzky's quote, you always be skating to where the puck is going, not where it is. But, as an entrepreneur, this came home to me recently because I had my head down in the weeds of like trying to grow my solar racking business and trying to raise money for that. And it was really hard to get investors excited about something that's simple, hardware, not AI, right? And then I finally had a conversation with an investment bank who said, we're really excited about you guys because we think where the puck is going is with recycled plastics and waste. Mm-hmm. And that was like an aha moment for me. I was like I've always thought of that as an added benefit to my product, but you're right. I'm so glad you said that. And so like we've been repositioning ourselves as like we're a plastic waste recycling company that happens to install solar easier, right? So are there examples of in your, again, a jump ball, in your portfolios where you think about this is where the puck is going? Everyone's talking about AI, but maybe they're not thinking about X, Y, Z.
That's really an early stage question, isn't it?
I guess it is, but yeah, that's right. I think we can start with Amy.
All right.
It's a jump ball to Amy, but
well, I think it's been pretty fascinating to see where the puck has been going because things like direct air capture, like literally sucking carbon out of the sky because of human production and consumption patterns, were considered a fringe investment a couple of years ago. I get pitched by DAC companies all the time. Long duration energy storage. Michael and I are co-invested into a company called Noon Energy, being able to store energy for 100 to 200 hours. That also seemed crazy a couple of years ago. There's been a lot of investment flowing. But where I think the puck is going, and hear me out, because I think people are going to think this is a little crazy, and again, from the emerging technology perspective, is I think blue tech. So anything that has to deal with the oceans. A lot of people don't want to invest in the oceans because the harsh marine environment, the projects are going to become more expensive, as well as the social license to operate is really tricky when you think about ecological impacts or impacts on coastal communities. But the ocean is an incredible opportunity for drawing down carbon. And I think that in the future, there are going to be really interesting and thoughtful entrepreneurs who are going to figure out how to navigate some of those really tricky elements of doing anything ocean related. And I think VCs are going to start to become more comfortable, with that, given the huge opportunity that's there, if we can do it thoughtfully and right. I'm not suggesting pillage the ocean and not be thoughtful about ecological impacts or community impacts, but I do think it's a really big opportunity where there's a lot of anxiety around engaging, but I do think it's where we need to go more broadly in the climate and clean tech space.
Okay, thank you. Any further comment on that, Michael?
Yeah, well, I'll add one, and it was alluded to a little bit, but I think the puck is going towards nuclear. I think traditionally there's been a lot of political risk, not technical risk, in nuclear coming of age. And so, particularly in the United States, there's been enormous policy traction and momentum in knocking down some of the barriers that have precluded us from cost effectively building a new plant for the last 30 years. And a lot of the communities that are built around maintaining and operating a coal-fired power plant really want to repower that grid tie. And so this is a new lease on life for those communities that I think is really going to change the political landscape around nuclear for the future.
I'm a big believer in too cheap to meter energy. I mean, to your point, renewables are now the lowest marginal cost source of energy, and the technologies that are built around it, either due to Wright's law of industrialization or due just advances in compute or advances in material science, we're getting to a place now where people are going to look to monetize this excess bulk power in ways that we haven't thought about before. And so especially from my perspective, I think there is a tremendous opportunity to kind of invest in companies that are monetizing and pulling together all these distributed sources of energy.
All right. I've got more questions than we've got time. And so maybe we'll just jump straight to, I want to give you the opportunity to talk about kind of one of your poster child successes, companies that you're most excited about. This is a free infomercial for you. And also tell us what you like about them and sort of, what's the secret to their success. So I don't know, maybe, Michael, let's mix it up and start in the middle.
Sure, yeah, happy to. So the one that came to mind when Drew posed this question to us is a company that has been implementing for the last couple of years a technology that's currently in vogue and in the zeitgeist of artificial intelligence. So we invested in Aurora Solar about 5 years ago. They were applying artificial intelligence to computer vision with a set of satellite imagery and LiDAR that allowed them to have a computer design rooftop solar much, much, much faster than a human could. We looked at what was holding back solar in the United States, and it was fundamentally soft costs. It wasn't the hardware anymore. It was the time it took to get a customer to yes, to design their system, to get the permits. And Aurora was applying AI to streamlining that workflow. They've been growing 100% year over year, basically since we invested in them. And it's been a company that we've been really proud to be a part of.
Wow, congratulations, 100% year over year. So the secret to their success is identifying the right market, but also the right strategic investment.
Yeah, and using a tool that was fundamentally superior to what the industry standard was.
And maybe just a follow-up question to that, how active are you in engaging with your portfolio companies like that?
Yeah, it really depends on the situation and how much we feel like we can be helpful. We try and stay in close contact with them and always keep our ear to the ground for ways that we can use our network or our insight to open up new doors for them that maybe they couldn't open themselves or maybe they hadn't thought to open yet. There's some companies that are just out there doing exceptional work and we do our best to keep up with them. There's other ones that for one reason or another have encountered hard times, and sadly those are the ones that I often have to spend more time with. So.
Yeah. Amy, you had the first word. Maybe we'll let Kojo have the last word. So if we could hear from you in terms of a company in your portfolio that you really want to highlight.
Sure. I'd like to highlight the first company that we invested in. It's called Lilac Solutions, and it was out of our predecessor fund to Azola Ventures called Prime Impact Fund. So what Lilac is doing, they're really in the business of lithium extraction. Lithium is very critical for the electric vehicle market as well as other markets, and they have developed a proprietary ion exchange bead technology. And the way that I like to think about it is essentially it allows you to kind of slurp up lithium at low concentrations and allows you to find lithium projects that are more in the money. So it's a more cost-effective, environmentally friendly way for direct lithium extraction. In 2018, there weren't a ton of investors focusing on lithium extraction. Actually, the founding team is incredible, but a lot of investors said, hey, we want to see more additional proof points before we can put capital into the company. We tend to lead or co-lead rounds, and as I mentioned, we're very early stage investors. So we were the first institutional capital into the company. We led just under a $1 million pre-seed round. And no, we worked with the company over 16 months on storytelling, team building. They signed several commercial agreements, including some of the largest lithium suppliers in the world, and that's partially due to the fact that there was an incredible team. They also had a technology with a fundamental entitlement, and then they went on to raise a $20 million, 3x oversubscribed Series A round that was co-led by Breakthrough Energy Ventures and the Engine, which is the Massachusetts Institute of Technology's Tough Tech Fund. Last year, they went on to raise a $150 million Series B round that was led by Lower Carbon Capital and T. Rowe Price, the financial giant. And I won't say any more than that because things are still in flux about a current fundraise. So all I mean to say is that we can go in quite early, try and identify areas where we think the puck is going, and then de-risk a company to really crowd in other conventional investors. And I think Lilac Solutions is a really good example of our model.
All right, good. Kojo.
I'm a big fan of Lilac Solutions.
Yeah.
I think,
All right. There's an endorsement.
Yeah, big fan. So Decarbonization Partners is only a year old, and so we're still very much in the early days of building out our portfolio. And currently have 4 companies, but we do have one company I think is pretty compelling, and it's actually a little bit different direction than where my colleagues here have gone. And so one of the biggest challenges right now is methane from animals. And so we've invested in an alternative leather company that takes mushroom roots and actually creates a leather product that is comparable to the finest leathers you can find out there. And we were really excited about the technology and the traction they were getting. And then recently, and this is what really made me a real believer, a large auto OEM came in and said, "We love your product so much that we want to partner with you to change all the leather components within our vehicle with your product." And ever since then, I think things have been going phenomenal, and I'm really a big fan. It's still early because, again, we are only a year old, but we're getting massive traction. And to your point earlier, and I think this part is really critical, as investors, either we're on the board or otherwise, it's very much our responsibility to help the company see beyond what they're dealing with on a day-to-day. I often describe it as if the company is a ship in an ocean, the company's job is to make sure that ship is operating and heading to whatever direction it wants to go in. As investors, it's our responsibility to know what the ocean is like, what the temperature is like, where the storm is going to be, are there other ships up ahead, is there an iceberg, and help that company know as they move through their business cycle, like, okay, this is what's up ahead, thank you for helping me think through those problems before they even become a problem. Very much kind of thinking over the horizons for the company. And that's how we approach all our investments, and ideally it's how we will continue to approach all our investments.
That's perfect. Well, with that, again, we're over time, but thank you very much. Audience, please help me thank our panel.